Hi everyone, welcome back to another section on strategic financial management. So today we're going to do the calculations related to financial ratios, and I'm just going to go through the formulas just so that you get a sort of revision, so you know what you're supposed to do today. So we discussed 5 ratios. We learned about liquidity ratios, profitability ratios, leverage, debt management ratios, investors ratios, and efficiency ratios. And then related to liquidity ratios, we learned 2 types of ratios: current asset ratio and asset test ratio. Profitability ratios, we learned 3 ratios, I guess, which is gross profit, operating profit, and net profit margin, and of course, ROCE, return on capital employed. And then we learned about leverage or debt management ratios. We learned about interest cover, gearing ratio, debt to asset ratio, and then investors ratio, EPS, DPS, and EPS, DPS, and dividend cover. And then we learned about the efficient ratio, stock holding period, creditors payment period, and debtors collection period, and also gave you the analysis, like how do you compare, and if it is higher, it's better. If it is lower, it's not good. Certain outcomes. So how should you do the analysis? So we've done with that. Now let's move to yes, so I'm going to use something called the keynote because I don't have a device that has Windows, and I don't have the Microsoft package, unfortunately, but I recommend you to use Excel, MS Excel, right? If you have the option of using MS Excel, please do, because it's more convenient than anything else, or than the one that I'm going to use. I'm just going to use something called Keynote because I don't have any other option. But if you have the option of using MS Excel, please do it. I'm trying my best to get the MS package because I really need it now. It's quite hard because, as I told you, I was talking about this integration. What do you call that? I forgot the term. Oh gosh, what's that word? I spoke about Mendeley, I spoke about these extensions. Yeah. So extensions only work with MS packages. So I can't do anything about it. I can't install any extensions to these apps, and I'm struggling with that. So if anyone has any idea on how to get the MS package to an Apple Mac, because I think you have to get a licensed version, and I'm planning to get that very soon, because since when you do extensive research articles or papers, you really need those extensions. So as I told you, those extensions I told you about Mendeley, I also spoke about other extensions. I don't remember now, but when I did the session related to journals, I told a few extensions where you can add it, and then it makes your work more easier. Yeah, and you also have this extension for citation and referencing, right, which is automatic. You only have to just feed the data. Okay. Oh, Google Sheet. I've not used that. I'll give it a try. I think, yeah, Google Sheet would be more convenient. Yeah, I'll give it a try. But for some reason I want the MS package. But yeah, I think I can use it online maybe. Okay, anyways. So today we're gonna do the calculations related to financial ratios. So I did give you a few annual reports to go through, which are from different banks. I gave you Doha Bank, Qatar Bank, a few banks from the Middle East. Those are some of the banks that I used for my analysis. So when I went through it, I decided to use a different set of data from the analysis or for the explanation today, because some of the information that you require to do the calculations is not available in those annual reports, specifically because they are, those annual reports are bank annual reports. Yeah, so it's quite difficult for you to, meaning when I do the calculations, I will not have the information that I need to do the calculations. Therefore, and this happens, right? This sometimes you will also get an issue where you will not have the information to do the calculation. Okay, so in that case, what you can do is you can use an alternative formula. There are alternative formulas that you can use. And if that is also not an option, then you can use a different formula instead. Right? Maybe you can calculate a different formula. So say for an example, when you were planning to calculate the gearing ratio, just an example, you have to calculate the gearing ratio, and definitely you will have information related to gearing ratio. Definitely. There's no doubt about it, right? But in case you don't have information, I'm just using an example. So if there is no information to calculate the gearing ratios, instead of gearing ratio, you can calculate the debt to asset ratio or something else. Got it? So one thing is that all the students, listen to me carefully. I want you to calculate. I want you to do the ratio analysis. I want you to use all the formulas that we've covered in this session. Some of them, they do the efficiency ratio, profitability ratio, and the liquidity ratio, done. Where's the investors ratio? No investors ratio. And then when I tell them, okay, you have not calculated the ratios, you've not calculated all the ratios, they say, oh, we calculated everything. I'm like, where is the investors ratio? And then they say, oh, they forgot. So make sure that you calculate all the ratios that we've covered in the class. This is the minimum, right? This is my minimum expectations. But if you can use other calculations, if you want to go for other analysis, maybe you want to expand your calculations, no harm in doing it. You can go ahead. Right. And also another thing that I want to say before I start is that you will understand when I'm doing the calculations. Sometimes there are alternative formulas that you can use instead of the formulas that is given in the slide. Right. It's like gearing ratio, you will have an alternative formula, which is like an easier version of the formula I'm going to teach you today. Right. If not, you can also use a gearing ratio, because gearing ratio actually gives you the formula that I've given you. So the formula that I've given you in the slide is actually an expanded version of the easy version. So this sort of give a comprehensive explanation about the gearing ratio, right? So this is comprehensive. This is like the most accurate. This gives you the most accurate picture of the company, right? But most of the students, majority of the students, I'd say, have problems in calculating the gearing ratio because the formula is comparatively complex to the other formula. So I thought today I'll give you another option where you can use that to calculate. So it's an easier version, right? It's an easier version compared to this version. Okay. All right. So everyone ready? Let's move ahead. So first I'm going to calculate the liquidity ratios, right? The liquidity ratios. Let's calculate. Oh, what happened? Why is it white? Oh, that's better. So I'm going to calculate the current asset ratio. Current asset ratio equals to current assets divided by current liabilities. Okay. So when you calculate, make sure that you write the formula. You have to write the formula. You have to. It's a must. It's mandatory. Because as I said, there are many formulas. You know, to find the same answer, you can use alternative formulas. There are many options, not to all of the formulas, not all formulas, like gross gearing ratio, as I said. What are the other ratios? There are a few ratio formulas where you have alternative formulas. So that's the reason you have to specify what formula you're using. So when you do the calculations in your workings, make sure you address or you write the formula that you're using. So I know that you're using this particular formula. Okay. And the other one, why does this keep changing? Oh gosh. Okay, right. The other one is the acid test ratio. So acid test ratio is the same ratio And the only difference is you're going to remove the inventory from the assets, right? Current assets minus inventories over current liability. So this, the result is actually, you're going to look into times. So current assets, can everybody see the annual report? If it's too small, please zoom from through your screen, because if I zoom, it might be difficult for me to get the data. Is it clear? Is the annual report clear to everyone? So I'm going to use the statement of profit, and this is also the company annual report. I'm going to use the profit and loss and the statement of financial position. Is it clear, everyone? Yes, okay, great. So current assets, we're looking into the current assets. So current asset is in the statement of financial position. So as you can see, current assets all the way here. Okay, and another thing, in majority of the financial reports, annual reports that is published, you will have two groups, two categories rather, which is group and company. So you're not going to select the data from here. No, you have to select company. Clear? Not group. You only have to look into company. This is the data that you have to look into. Okay. So I'm going to calculate for 2 years because it will be easy for me to do the analysis. So I'll be able to tell you how to compare the 2 years. I need, yeah, so let's do 2020 and 2021. Sure. I will send you the screenshot of the financial, sorry, yeah, I can send you the document. Okay, what are we supposed to take? Yes, current assets, sorry. So current assets, as you can see, we have 2 years. So current assets are over here. See, under current assets, we have total current assets. See this? So we only need this current asset, not the group current assets. We're not going to touch that. So we're going to take this one. Now here we have 31,178 to 2021, and 2020 it's 25,350. Okay, and now let's look into the current liabilities. So current liabilities is all the way down. So you have to go, now you have the non-current liabilities here. So current liabilities is over here. Again, you have the total current liabilities, which is this, and we only need this data, right? Which is 32,989. And when you copy paste data, be very careful because you're going to compare 2 years. I think for you, it's 2 companies, so I don't think you will have the issue. But if it is 2 years, make sure that you write the, you take the correct information to the correct year. So done, and 2513. So either you can do the calculations manually or you can do it through the Excel sheet. Some of the professors, they love to do manual calculations and I have no idea why they do it. And even SPSS, you would have heard the software called SPSS. Yeah. When you were doing your degree, or if you have done any research, quantitative research, you would have used an app or a software called SPSS. There's other softwares that there's so many softwares out there, but SPSS is widely used because of its simplicity, I would say, compared to other softwares. So one of the professors at the university, she was saying that all the calculations that she did for her research, she did it manually. Even when she was using the SPSS software, but majority of the calculations or majority of the entries, I don't know whatsoever, she said that she did it manually. And she said it was easy for me to do it manually. And it was surprising, and I still couldn't figure out why it was convenient for her to do it manually when things are easier here. Anyways, so now what are we going to do? Current assets divided by current liabilities. So we're going to simply do this. And this divided by this. So we got our answers. It's 1.0. So I'm just going to take 1. and 0.9, let's take 0.94 is 0.95. Clear? So we have 1 and 0.95, which is 1 time and 0.95 times. Now, you know that current asset ratio, I also told this is, they use another term called working capital ratios, and they compare the liquidity of the asset. And as you can see, and I also told about the ideal ratio, right? If the ratio is above the ideal ratio has to be between 1.5 and 2. If it is more than 2, it's a problem. If it is less than 1.5, it is still a problem. Now here, as you can see, both years, it's unfavorable. Why? Why is it? Because it is less than the ideal ratio. But when you do a comparison, you can say in 2020, company has done better than 2021 when you compare, right? As a comparison. But still, both years, they have got, or the result of the current asset ratio is less than the ideal ratio, right? And again, this ideal ratio will vary from industry to industry, right? From industry to industry, it may vary. So this is the analysis. And then you can give certain recommendations or suggestions on how to improve that ratio under recommendations, okay? So this is current asset ratio. Now we're moving on to the acid test ratio, and acid test ratio, we're going to use the same information, but we are going to add one more information, which is we're going to take the inventory out. So let's take the inventories. Inventory, where are the inventories? Inventories are under current assets. Okay, so you go to the current assets here. There you go. So you have inventory. Sometimes you might find another word called stock. Stock also means inventories, but now organizations use the term inventories. But you might find the word stock, which also means the same. So here you're going to take the inventory amount, which is 2039 for 2021. Wait, did I take it right? I hope I took the entries right. Wait a minute. Wait, total assets 30, current assets 31,178, 2021. Yeah, correct. Correct. Yes, I'm on the right track. Okay, 2039. Inventories 2021, 2634, 2020. Oh no, I put it in the wrong. Oh, what did I do? It's supposed to be here. Okay, 2039. So now you do the calculation and tell me. Because I did the current asset calculations. Now you do the calculation and tell me the result that you get for asset test ratio. And again, asset test ratio and current asset ratio, there's not much of a difference. The only fact is that you're removing the inventory from the current asset, meaning you're able to find out whether the company is able to meet short-term obligations without having to depend on inventories. So that's the only thing that you're checking in the asset test ratio. So everyone calculate and tell me the result. And please drop a private message. Don't put it, because I want everyone to calculate. Everyone, please calculate. You have to do this. And yes, another thing, actually, I did a few tests using ChatGPT, because in the past, some of the students had used ChatGPT to do the calculation. So I thought maybe I should give it a try and see whether you get the correct result. Don't use ChatGPT because I don't know what they're doing. Majority of the answers that ChatGPT gave, it's wrong. And when I tried to clarify, they're like, oh, yes, that's a good observation. I missed it. So if you have a plan in using ChatGPT to do your calculations, please don't. It's not going to work. Or any other AI software. For some reason, they can't do calc. I think they've not developed up to that level yet. And even science calculations like physics, chemistry, they do a lot of mistakes. We actually ran a test. We sort of did a research about it. Yes, Kosala. Let me check. Give me a second. Let me do the calculation manually. That is correct, Kosala. Good job. That is correct. I'm waiting for, if I get at least 5 responses, I'm going to move forward. So I'm going to take the results separately, which is this minus this. Okay, and I'm just going to do the calculation afterwards. You have to do this working in the Excel sheet, and you have to attach. You have to attach the workings under appendix in your assignment. Make sure that you do so. When you do the workings, save the document. I only got 1 response. What about the others? That is correct, Zahra. Good job. Two more, at least another 1 response. I only got 2 responses. What are the others doing? I've literally given you the data. You just need to do the calculations. That's it. You can even do it manually. Just enter the data on your calculator, or if you're using an Excel sheet, it's much more easier. Just tell me what you got. I want everyone to do it, please, because you have to do the analysis for your assignment. Anthony, for which year is this? Are you sure, Anas? Check again. Check again, Anas. Maybe you've done, maybe there's an error somewhere. Check again, please. See, this is why I tell you to do it. So you know whether you are on the right track or not. Everyone, please try it. Okay, I can't wait anymore because I have to finish at least a few formulas. It's already 30 minutes gone. Gosh. Right, so current assets minus inventory. So let me calculate it here. So this is a current assets minus inventory divided by current liabilities. And again, current assets minus inventories divided by current liabilities. So the answer is 0.9 and 0.88. This is the answer. So this is liquidity ratio analysis. Again, the analysis, sorry, the interpretation and the analysis is the same. Same as the current assets. Okay, all good. So now let's move on to profitability. To B-TIC ratios. Right. So profitability ratios, I believe I gave you three formulas, which is the GP, gross profit ratio. So what's the formula for gross profit? Gross profit margin. Yeah, I gave you the gross profit margin. So gross profit margin equals to gross profit divided by sales into 100. So here you calculate as a percentage. Okay, into 100. And then I also gave you another formula, which is operating profit margin. So just put OP margin, which is equal to easy operating profit over revenue or sales. Revenue, sales means the same. So here I will use the formula or the term revenue, total revenue, just so that you get the fact that, you can use it interchangeably. So operating profit divided by total revenue into 100. And the other formula that I gave you, I think it was net profit, if I'm not mistaken. Net profit margin. Let's put NP margin equals to easy net profit divided by sales into 100. So easy. You can remember the formulas easily. See? Gross profit, it's gross profit over sales. Operating profit, oh, not operation. Operating profit over total revenue into 100. Net profit over sales into 100. Revenue, sales, you can use it interchangeably. Okay. So now let's calculate the gross profit margin. So here we are going to you are going to take the gross profit. Where do you find the gross profit? Anything related to profit, loss, expenses, income, it's in the income statement. Anything related to asset, liability, it's under financial position. Or you also call this, you use another term, you call this balance sheet, right? But most of the annual reports, you will find this term, statement of financial position. But in accounting books, you might find the term balance sheet. It means the same. Okay. Right. Here you have the gross profit over here, which is this line. Let me show it. Let me highlight it for you. Here you go. Under direct cost, you have the gross profit. So here we need the gross profit of the company for 2021 and 2020. Okay. And now we need the sales. Again, sales is at the top line. See here. Revenue, sales, that's what we want. So it's 59,811 for the year 2021. Wait, which is 2021? Oh, did I do a mistake? I did. Oh, okay. I should make this 2021. I think I did the same mistake for the previous question. Just check it, okay? When you're recording the data, be careful. You might do this error. Okay, let me check again. Yeah, that's correct. This is for 2021. Okay. Sales, again, I'm going to write the sales for all three because we will be using the sales for all three. This and this. So let me take the data for all three. Okay. Operating profit, you have it here. Yeah, exactly. That's correct, Kosala. Just check the previous question. And not the values have not been mixed up. I think the years got mixed up. So now I changed the years. I don't know whether I did the right thing to the previous formulas. Just check that I did maybe I've used the 2021, 2022 interchangeably. Anyways, let's move forward. Where's operating profit? It's over here. So I'm going to copy paste that. Which is 2021 and 2020. You can do the calculation for the gross profit margin. And then you have the net profit over here, all the way down. You get the net profit, which is this one. 5865. 0.4019. And then you do the calculations. That's it. Everyone start doing the calculation. Let's do this one. I got a few answers. So Zahra, that is correct. Good job. And everyone check whether you got the right answer because I can't wait. I need to cover this up soon. 43, again, this divided by this into 100 equals this divided by this into 100. This divided by, see, I told you the calculation is very easy. You just need to enter the data and calculate. That's it. Simple. This divided by this into 100. Again, the data is provided in the annual report. You just substitute the values to the formulas. That's it. Okay. So gross profit margin, we got 41.6 for 2021. So if we round it off, it will be 42 and 43 for 2020. So gross profit margin, what does it do? It indicates the gross margin of the company expressed as a percentage of sales, right? So this ratio includes the amount of profit a company makes after setting off its cost of goods sold. And the ideal gross margin ratio will vary from industry to industry. However, higher the gross profit margin, the better it is for the company. So when you compare the 2 years, you can see that they've done a better job in 2020 compared to that of 2021. All right. The next instance, which is operating profit margin. So when you look into the operating profit margin, now this analyzes the company's financial health, right? This analyzes the financial health of the company. As a general thumb rule, the ideal operating profit margin and also the net profit margin, both it is 20%, right? So 20%, it is favorable. 5% is considered to be too low. Now you can see the operating profit margin of both years is low. So it is not lower than 5%, but still it's in that, at that margin. So this indicates that there is a major problem with the company. Now, when you look into the net profit margin, it's compared to operating profit margin, it's okay. Right? So net profit margin, this measures the capability of a company to convert its sales revenue into net profit. Right? So again, the result, the outcome is low, but when you do a comparison, 2021 is better than 2020. So you can say to improve net profit margin, what can the company do? So in here, you can say to improve the net profit margin, the company can increase its sales revenue by increasing the price of the products, or they can also increase the quantity of goods sold. Yes, they can use various promotional strategies to increase the sales of the product. So you have to give these kind of suggestions if you need to, right? If the task asks for recommend, I don't think they ask for recommendations. They only ask you to do a analysis, a comparison. Is it clear? Understood how to do the profitability ratios? I mean, did you understand how to do the calculation so far? Good? Yeah? Why is everybody quiet? Did you get it? Yes? No? Say something. Yes. Okay, great. It's easy, right? Okay. So now let's move to the next one, which is leverage ratios, or you also call it debt management ratios. So you can use any word. So I'm gonna take this off. Right. So the gearing ratio formula that I gave you in the slide was this. Gearing ratio equals, so I'm going to do, no, if I do 1 year differently, no, I'll do something about it. Right. Gearing ratio equals to long-term liabilities over, right? Over shared capital plus retained earnings plus again long-term liabilities, right? Long-term liabilities. This is a formula that I gave you, and this is a comprehensive formula, right? This will actually give you the accurate picture of the company. But you can also use an alternative formula, which is way easier. If this is difficult for you to find, if it is difficult for you to find the data in the annual report, you can use an alternative formula, but you have to give the preference to do this first. If you find it difficult, give it a try. At least give it a try. If you can go ahead with this formula, use it. If not, you can use an alternative formula, which is total debt divided by total assets. That's it. Okay. But again, this is only an alternative formula. But I advise you to use this formula to find the gearing ratio. Okay. I want you to use this formula to find the gearing ratio. And then I also told you to use debt to asset ratio. What was the ratio that I gave for you? Debt to asset ratio, I forgot. I can't remember the formula that I gave you. Give me a second. Let me check the slide. What was the formula? Okay.
Is that total debt over total assets?
No, I think there's a mistake in the debt to asset ratio. Give me a second. Let me check. Debt to asset ratio. Give me a second, please. Yeah, that is a formula, but that's the same formula, alternative formula that I gave here. So anyway, we're gonna find the answer for both debt to asset ratio. But I want you to find another ratio because I only gave you two ratios, debt to asset ratio and gearing ratio in the slides. That's not enough for debt management ratio. So I'm going to give you another one, which is interest cover ratio. Okay. Interest cover ratio. You can also use this ratio. And don't worry, most of the time, the interest cover ratio has already been calculated in the annual reports. You can find it, right? You'll be able to find the interest cover ratio in the annual report itself, meaning they would have calculated it already. So you can just copy paste it. There's no problem. There's no harm in it. Okay. If you find the data, if you find the result, or if you find the, say for an example, EPS, earnings per share. Now, I think for majority of the majority of my calculations, I remember I did not calculate the EPS. I did not use the formula for majority of the calculations that I did previously for my past research, for my past analysis. EPS, DPS, I have never calculated, right? But I have calculated when I had to do researches, or when I had to do assignments, rather, not research, sorry. When I had to do the assignments, I had to calculate because my lecturer said they need to see how I, put the data in the formula. But when I did research, I did not actually calculate the EPS and DPS because it was already given in the annual report. So what you can do is calculate the EPS and DPS and double check it with the calculations provided in the annual report. Okay, so I would like you to do the interest cover ratio, which is EBIT, earnings before interest and tax. Earnings before interest and tax divided by the interest expense. And as I told you, majority of the annual reports, they provide you the interest cover. So you don't actually have to calculate it. So if it is provided, you can just give a clarification that these calculations were already provided in the annual reports. Therefore, the calculations are not done when you're doing your research. Right here, when you're doing your assignment, you have to calculate it. Right, now let's move on to the gearing ratio. So gearing ratio, we have to take the long-term liabilities into consideration. Now let's look into the long-term liabilities. So here we are going to take 2021 borrowings, lease liability, contract liabilities. So it is under non-current, so it is a long-term liability. Okay, I'm going to give you a minute to calculate it on your own, and then I'll help you how to do it. Try to at least, try to substitute the values to the formula. You have all the information here. Yes, all the information that you need, it's here in this space. You can do it. Take a minute and try to do it. Were you able to find it? Anyone? Okay, I'll help you. You have to take these into consideration when you calculate the long-term liability. Borrowings, lease liability, contract liabilities, and deferred tax liabilities. This has to be taken into consideration. Okay, I'll help you. I think since you're doing it the first time, it will be difficult. So I'm gonna calculate this entire thing manually and then enter the total here, okay? The long-term liability. So as I said, you will have to take this, 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 and this, 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 and this. So I'm gonna use the calculator. 35,807, 613 plus 1071 plus 4870. 42,361. Did I miss anything? No, right? Anything else? Anything else? No, that's it. Lease liability. Correct. Let me do the calculation again. Everybody calculate, please. 4875 plus 27 plus 660 plus 6936. 6936. 6936. 48,498. 48,498. And here it is 35,807 plus 613 plus 1071 plus 4870. 42,361. 61. Okay. Yeah, 42,361. That is correct. Divided by, okay, this, I'm going to put it within brackets. Shared capital. Here, shared capital is not given. Therefore, I'm going to take stated capital. Okay. So shared capital is not provided. Therefore, I'm going to take stated capital instead of shared capital, which can be done. It's fine. You can do it. So in 2021, it is 18. Oh, okay, it's the same thing. Both years. 18,049. So I'm going to copy paste. And then retained earnings. Retained earnings, it's over here. Okay. So this is 2021, right? If I, you know, if I mix up, please let me know. I might. Oh gosh. Plus, I shouldn't put it in brackets. Okay, so it's providing a negative value. 43350. Okay, I think I've recorded it right. I mean, in the right place, 2020 and 2021. Yes, right? Yeah, 2021, 2020. And again, long-term liabilities. So I'm going to add this up again. Here is this. Okay. So we're going to add this up. Plus 465. That's 049 plus 46,518 plus 106928. Let me know whether I got the right answer. I might be wrong. So if I'm wrong, please correct me. $43,350 plus 48,498. 09,897. Okay. Oh gosh, what happened? Okay, I know what to do. Right, now let's calculate this divided by this. Sorry. Oh, I forgot to write into 100. I missed it. It's into 100, okay? This divided by this into 100. This divided by this into 100. Okay, so 2021, you get 39, almost 40%. And here it's 44%, 2020. Again, you can use a total debt or total asset ratio, which is easier. Meaning what you have to do here is take the total debt. Total debt means the entire liabilities, right? Divided by total assets, which is the alternate formula. But I shouldn't have given you the alternate formula. I want you to use this formula, okay? Because this gives a comprehensive view, or it gives a better picture or accurate picture of the formulas. And interest cover ratio, EBIT, and in this particular annual report, there's no EBIT. So therefore, I use the PBIT, which is a profit before interest and tax. And for that, I use the operating profit, which is provided here. Right? So I will show you the calculations now. Before that, see whether you get the answer for the gearing ratio. Everyone, please try it out. Take a few minutes and try it out because you have to do the calculation for your analysis. Didn't I calculate rows for profitability ratio? Oh, I forgot to calculate the rows. Oh, that's a very important formula. I missed it. I'll calculate the rows as well. I completely forgot. Okay, I'll quickly calculate the interest cover ratio. We have the operating profit, 3336 and 3502. And what's the other one? Interest expenses. Interest expenses over here. And actually, I wanted to take only the interest expense excluding the finance cost, but there were not much details related to interest expense. So I'm going to take the whole thing. It might not give an accurate picture, but it'll be somewhere closer to the accurate picture. I forgot rows. I don't know why. And this one divided by this. That's it. Okay. Okay. Right. Yes. About the interest expense, 1.83 and 2.517. So the interest cover ratio, I forgot about it. I actually did not introduce you to this formula, right? So interest cover ratio, this shows the amount of profit available in the business to cover up the interest that the company owes. Okay. So the average ratio cover is 1.5 and any ratio above that, it is good, it is fine. And as you can see, both the years in 2021 and 2020, the company's interest cover ratio is more than 1.5, meaning they have enough earnings to cover up their interest expenses. So this is favorable. Yeah. And then, yes, talking about the gearing ratio. Now, the gearing ratio is a very crucial ratio for an organization. Now, gearing ratio compares the owner's equity with the borrowings of the company. Right? So here, the company's financial capability can be measured by the above ratio. Get it? So when the gearing ratio is more than 30%, which is both, yes, it's 39, 44%. So when the ratio is more than 30%, it is difficult for the company to borrow loans from banks. So if the company is planning to take loans from banks, they have to ensure that they bring down the percentage to less than 30%. So this particular company has to improve their gearing ratio to attract the banks. So the gearing ratio can be improved by increasing the equity. Now you may ask me, how do I increase the equity? Equity can be increased. The equity of the business can be increased by issuing more shares. Right? More shares can be issued to increase the equity, and profit can be retained. Maybe you can increase the retained earnings, pay out less dividends to the shareholders, and retain profit. Again, there are consequences. Paying less dividends to the shareholders can cause consequences, but you have to sort of balance and try to increase the equity, equity in order to improve the gearing ratio. Right. So finally, we'll do one more formula, which is the rows. I completely forgot about it. I don't know why I missed it. So we'll only calculate the rows and then continue with the rest of the ratios tomorrow. We have to do efficiency ratio and investors ratio. Investor ratio is very easy, okay? Investor ratio is very, very, very easy. And again, efficiency ratio is easy as well. You just have the information and you just need to substitute. Right, let's look into the rows, which is return on capital employed. So rows equals to, who can remember the formula for rows? I forgot. You tell me, what's the formula for rows? What's the formula I gave you? Let's see who can remember. At least go through the slides and find out. What's the formula for rows? Return on capital employed. It's equal to PBIT divided by capital employed into 100. So again, capital employed, you have to calculate the capital employed to these questions. To this formula. So you have two ways of calculating the capital employed. One formula is total assets minus current liabilities, which is a formula that I'm going to use, that I usually use. I usually use this particular formula. There is another formula, which is, what's the formula? Equity minus non-current liabilities. Okay, this is another formula, but I usually use this formula, total assets minus current liabilities. And again, for PBIT, instead of calculating the PBIT, if you're doing a research analysis, right, you're doing an extreme study on it, then you will have to calculate the PBIT. Right, you have to get into those, go to the notes and exactly find out what are the interest and then get the profit before interest. But here you can use the operating profit, okay, just to make things easier. But again, I repeat again, if you're doing a thorough analysis, you're doing a financial analysis, because you really need accurate data, then you have to go with PBIT or EBIT, earnings before interest tax, or profit before interest and tax. So here I'm going to use the operating profit alternatively. So 336 for 2021 and 3502 for 2020, and capital employed equals to total assets minus current liability. Where's the total assets? So again, here we are going to take the total assets. Total assets minus current liabilities. Total assets and current liabilities. Did I take the total asset? Did I do it right? 2021, 2020, yes. Where are my current assets? Wait, total assets minus current liabilities, sorry. Current liabilities, it's over here. So when you're doing the calculation, make sure it's organized. Now I'm using it this way because I just have to show you how the calculation is done. how it's subtracted, how it's, multiplied and everything. But when you do it, make sure that it's organized. Remember, I showed you, after this session, I'll show you how you can organize everything. Right. So first thing is I have to get the capital employed, which is this minus this minus this. So I have my information. Let me highlight it. So you know what calculation to take into consideration. So rows equals to divided by this into 100. This divided by this into 100. Okay. Check whether the calculation is right. If it's wrong, let me know. I can correct it. So anyways, related to the rows is this analyzes the return of the business received as a percentage of their investment. So rows, when you calculate the rows, you're able to measure how well a firm has utilized its internal and external sources of the company. So the ideal rate for rows is 20% and above, and you can see both years, it's way below the ideal rate. So they really have to do something to increase their return on capital employed. Return on capital employed. All clear? Is everything clear? Yes. Is it fun? Is it good? Did everyone understand? Either you understood or you did not understand at all. Understood. Okay, great. So thank you so much for attending the session today. I'll see you tomorrow at the same time, and I will continue with the rest of the form.